Good afternoon, everybody. It's Mark Coe for the 22nd of March. Here, I wanted to talk today about a topic that seemed a little intriguing lately. I'm hearing a lot of people discussing this, and the idea of trading a range versus trading a breakout, and or to make it a little more specific to my friends in the short-term world, fading the market versus going with the market trends. There's something pretty appealing about watching a market trade, I don't know, let's call it 1 point wide and buying the bottom, selling the top, and doing it multiple times. And all of a sudden the market's gone nowhere, but you've made yourself several points. The opposite idea of that can be equally as painful, where you're anticipating a market to stop and you all of a sudden are on the opposite side of what is developing into actually quite a nice trend. I wanted to highlight, as we start out this discussion, this dollar yen. Thinking back to the last several months since the presidential election, so we had the big ignition move higher up to above 118 in dollar yen, and then for the better part of the last couple months, dollar yen is trading what could easily be described as a nice range, with 111.60 kind of marking the bottoms and just above 115 marking the tops. All in all, it's a very tradable range, very tradable. All of a sudden, overnight and throughout the U.S. session, dollar yen has been able to break out that bottom edge. And so I think what you want to look at from a standpoint of time frame is to say, well, where am I in this actual run? And so one of the mistakes that I see traders tend to focus on is they get too wrapped up in any one time frame, which is always, in my opinion, a dangerous thing to do. In other words, you may look at a 5-minute chart or a 15-minute chart and say, well, this is the whole world to me. Everybody is trading off of a 15-minute chart. It's just simply not the case. There's lots of business being done in multiple time frames that has nothing to do with speculative type money. It just doesn't. So the idea that the whole world is existing on a 15-minute chart is just it's just not accurate. But some ways, even with a 15-minute chart, that we can kind of help to put the advantage more in our favor. How could we do that? Well, if we start out with longer term analysis, and I'm always a fan of doing this top-down analysis, and I say, well, let's look at dollar yen. Dollar yen has been in this real beautiful trade range. I've heard Mark talk about it for days. There's got to be something to it. All right, well, 111.60 is the bottom and 115 and change is the top. That's beautiful. Now let me come in and see what's going on at those real levels. So this is where the short-term trader needs to take a little stock into what they're doing and say, I've done my work. The daily chart's not going to change every 5 minutes. After all, it's a daily chart. But it is worth looking at once a day, especially this is my job, this is what I do for a living. It's worth looking at. And likewise, I could take a peek at a weekly chart on Sunday evenings before the week starts. But on a short term, how does this big level, this 111.60 rate on a short-term chart? So if we go highlight this 111.60 area, just even as a short-term trader, would I get hurt if I played longs against 111.60? Would I get hurt? That's the question. Would I get hurt? The only way I'd really get hurt is if I ignored the reaction to the level, meaning once we took out that level on a short term, I ignored it. It's the only way to get hurt. Could I have lost money taking long side into us? Could I have discounted all the sell side action that got me here and taken along? Sure, I could do that. But it doesn't mean that I can ignore what's right in front of me, especially as a short-term analyst, short-term trader. What I can start to piece together at this 111.60, which has been good support for months, is that the market is no longer buying this level up. It's not. So if you think about kind of even how it would have looked coming into play here, there's your 111.60. You got a test of it yesterday afternoon. Market gave you 10, 15 ticks bounce from it. And then all of a sudden, those bounces aren't occurring. So as a short-term trader who doesn't have to be overly opinionated, right? You're not the treasurer of a multinational company. You don't have to have an opinion of where dollar yen goes over the next 3 quarters. But as a short-term trader, you have to keep in mind, what is your goal? Your goal is to capture short-term movement, or at least be aware of what the risk is within that short term. So what's the risk on this really big level? Well, the risk is it takes it out and there's a bunch of stops and you move below quickly. All right, fair enough. But once the market starts to fail to buy side off of it, doesn't it become pretty clear that even in the short term, the sellers still maintain their edge and will still push the market lower? Doesn't it become pretty clear? And so if you go through and do the analysis like I've been talking about, which is to say at each battle zone, who's controlling a market? So going back the last week in dollar yen, right? Dollar yen had this magnificent sell-off after the FOMC. Listen, I was all lined up to buy dollar yen, bought it a few times, didn't work. But did I hold on to it and ignore that the buy side was not the one winning? No. At each battle zone, right? So I'm highlighting this 1350 battle zone. Who won it? Top edge, who won it? Sellers won it. Who wins bottom edge action? Sellers. The next top edge that gets put in place, who wins it? Sellers. Who wins at the bottom edge? Sellers. So it's a pretty easy theme, especially for the short-term trader. So this idea of having to fade yourself away and say that you have to take the opposite side of the market becomes a little silly when the analysis should be that clear to you. The standpoint of saying, hey, who's controlling the market at this stage? Who's controlling it? Well, right now sellers are. But on this approach to the most recent lows, can we not draw a real-time bottom edge forming? Absolutely. So our question would become, back at this key 111.60, who's going to win that area? And we don't know the answer to that. All we know is the area to highlight to determine who's going to win it. So as we come into Friday morning to Thursday night Asia, the 23rd of March, this is how we're focused. But the idea of trading against the trend can be unbelievably painful in a market that's just starting to trend. And so the idea of at least recognizing those signs that are pushing a market one way versus the other, you cannot have this standpoint of, I'm going to go down with the ship, dollar's going to go up forever. The bottom line is nobody can tell you that. What you have to trade is your own P&L, your own risk, your own parameters. What I can show you is how you're able to diagnose that and put yourself in a more favorable position. That's the idea. So regardless of your time frame, your outlook, you still want to be concerned with who's controlling the market and at what levels are they battling from. And that really becomes the key, the cornerstone of what you're doing. So if you're looking at dollar yen and you're looking at it from a long-term standpoint, you say, well, it was clearly dollar yen was bought up from this level the last time it was here, right? Here's dollar yen on a weekly chart. The last time it was at this 110.90 area, it was bought up. All right, fair enough. Fair enough. But now tell me on a shorter term what you're looking at. Because the idea of saying I'm going to use this weekly analysis, but I'm still going to trade off of a 5-minute chart, it's not going to flow quite as easily. So it makes more sense to come into the market and look at it and say, show me an edge. Let me see an edge develop that actually holds and let me play against that edge. And don't forget, at the end of the day, life is going to feel a lot easier in the trading world when you're not fighting the momentum, right? So if something is going to range trade, let the range trade present itself. But when a market starts to trend, don't forget how much money can be made or lost within that trend, and don't fight it. So those are probably the easiest thing I could tell you about it is it's the earlier recognition that really allows you to participate, but more than anything, you don't want to stand in the way. That's why I use that long-term model. That's why I don't trade against the model direction for any length of time, and why those stops are so key, because at the end of the day, against the model direction, it will still get you out, and it will not allow you to really get hurt from that standpoint. So for 22nd of March, hope you guys enjoyed it. Just a little look here at the trend versus the fade mentality. And yeah, you have any questions, shoot me an email. Love to hear from you. Cheers, everybody.